Welcome back. Chapter 25, Section B, External Sources of Finance. In this chapter, we want to speak with together about the important external sources of finance, that they are come from outside of the business and look like the momentums act in the business. You need that to build your own momentum, and also businesses need to make their momentum. And the external sources is acting as an external momentum in the business. So let's look like we together the different external sources of finance. As we discussed with together in previous videos, the external sources of finance are divided to 10 different sources that include bank overdraft, trade payables, credit cards, loan capital, unsecured bank loans, mortgage, debenture, hire purchase, share capital, and venture capital. Before understanding and analyzing each sources of finance, each external sources of finance, we need to know more about the external finance. The external finance is the money that comes from outside of the business, as you remember, as it's come from outside of the business and act as a momentum in the business and include long-term and short-term. So what is important here for the external sources of finance is that it's include long-term sources and short-term sources. But we don't have this division for internal sources of finance. But again, for external sources of finance, we have the two different sources, long-term and short-terms. Bank overdraft, trade payables, and other until venture capitals are the 10 different sources of finance that come from outside of the business. Start from bank overdraft, that is short-term external sources of finance. The bank overdraft is businesses facilities that give the businesses this opportunity to spend more money than it has in its account. So give the business this opportunity that it spend more money than it has in its accounts. And a business may use bank overdraft as a short-term sources of finance. So bank overdraft is one short-term of sources of finance, and it give the businesses this facility to spend more money than it has in their account. The next short-term external sources of finance is trade payables. And this is you can buy resources now and pay for them later. So in trade payables, you can buy resources now and pay for them later. And generally this later is between 30 to 90 days. And it means that business hold on its cash for longer. So you can have more cash in the business when you use trade payables. And this is the important advantage of this external short-term source of finance. But what is the disadvantage? This is the important part. So we have one advantage. And what is the disadvantage? There are three disadvantages for trade payables. First, many suppliers encourage early payments by offering discounts. So you lose discount by trade payables, the discounts that is belong to early payments. Second, the cost of goods sold is often higher if farmed by on credit. So generally it's increase your cost. And finally, delaying payment may upset supplier. These are three disadvantages of trade payables as the external short-term sources of finance. After explaining the trade payables advantage and disadvantage, also we want to explain some examples about the trade payables. For example, you raw material purchase or buy some raw materials by manufacturers, and money that restaurant need to pay to food companies, and item of clothing sold by retailers, and wine or beer bottles bought by bars. All of them are different example of trade payables that they buy now in the current time and pay for the resources in later time between 30 to 90 days. Next, external short-term sources of finance is credit cards. The credit cards are popular because they are convenient, flexible, and avoid interest. They are advantages of credit cards and importance. They are convenient, flexible, and avoid interest. Executive can use to meet expenses when traveling on company businesses, and small businesses use it to buy materials. And interest rate on credit cards will vary high if accounts are not settled, usually in 56 days. And this is a disadvantage of credit payables, that interest rate on credit cards will be very high if accounts are not settled, usually in 56 days. The next external sources of finance that could be short-term or long-term is loan capital. The loan capital is fixed agreement between business and bank. So loan is agreement between business and bank. And the amount of borrowed and interest must be repaid in regular installment over fixed period. So you borrow some money as a loan from the bank, and the amount of the borrowed and interest that you should pay on the amounts that should be paid back or repaid to the bank in regular installment over the fixed period, and they can be short-term or long-term source. The next external financial sources is unsecured bank loans. So in unsecured bank loans, bank lends money without this is unsecured, so without the security of having a claim on your assets. So your assets is immune, and bank have no having claim, no security, or no having the right to claim on your personal assets if you don't pay back its money to the bank. And if the business collapses, the business might not get the money back, so the money cannot claim on your assets if your business is collapsed. Mortgage is a long-term external sources of finance. So mortgage is a long-term loan, and borrower must use land or property as a security. In the previous part, we said that we have the unsecured bank loans, but the unsecured bank loans naturally is very rare. But mortgage is a long-term loan that the borrower or bank must use land or property as a security. If the borrowers fail to pay back the debts or fail to repayment, the lender or bank can repossess the property. And popular lower interest rate. The mortgage generally have lower interest rate, and they are long-term external sources of finance. The next external sources of finance is debenture. Debenture are a creditor of the company, not owners, and fixed rate of return, but no voting rights, and they must repay it within the set date. Debenture. Next sources of finance is hire purchase, and they are usually more expensive than bank loans. So you can pay the amount of loans in monthly repayments, and after sometimes when you pay back your debts between 24 to 36 months, you can own the car. The next is external sources of finance is share capital, is raised more money by selling more shares. The advantage of share capital is interest payment is avoided. This is the most important advantage of share capital. Please remember it carefully. So in the share capital, interest payment is avoided, and shareholder expect to pay dividends or profits of the shares. And disadvantage of share capital is that raised capital is the cost of administrations is high. The cost of administration of share capital is high. And the final external sources of finance for this video is venture capital, that generally used for a startup activity for entrepreneurs. So venture capital is for a small and medium sized company, and prefer to take a stake of the company, and they will have some control when the venture capital pay to you the money. And some venture capital are individual that may be called business angels, and finding suitable angel with the same interest rate for future business could be challenging. Thank you so much for your precious attention. We will continue to the next chapter in the next video together.